cash and financial instrument. So when we audit this particular section, if you can recall, if you have learned somewhere in your financial accounting and reporting subject, okay, if you will learn to, if you already learned about how to prepare cash flow statement, okay, so you have the last line where you have cash and cash equivalent. Okay, cash and cash equivalent. So cash and cash equivalent mean that is actually refer to anything can be transformed or liquidate into cash in a very fast manner. Okay, that means what can easily be transformed into cash, okay, from the asset. So normally cash and cash equivalent would actually include cash and also other financial instrument. So the most common in this particular section when we audit, it would actually comprise of cash at bank. Okay, that means whatever money that you have in the bank, regardless of how many banks, because most of the time company would have more than one bank. Okay, because sometimes they would like to separate the money that they use for operating purposes, okay, for the working capital purposes, to roll the money from the collection of the receivable and then to make the payment for the payables. Okay, so that's what you mean by working capital or operation purpose. And then they also sometimes would like to have a separate account for payroll. Okay, because normally payroll involve a lot of payments, right? Because you have many employees in the company, like thousands, for instance, especially manufacturing company. So you would like to monitor, okay, whether the payment is all settled or not, and so on, what are the pending payments and so on. So in order to have a better monitoring, so most of the time they would actually prefer to have one bank just to cater for payroll purposes. So what happens is that at the end of the month, okay, when the times come to make the payment for the payroll, they will transfer the whole lump sum to that particular account, and they will instruct the bank to make the payment direct debit into respective employees' account. Okay, so sometimes they might have issues whatsoever. So from there, it's much easier to close monitor what are the issues of the payment that have not been settled and so on. So they would have one bank for payroll purposes. Okay, and then apart from that, you would have cash in hand. Okay, cash in hand, or sometimes they call it petty cash. Okay, petty cash, meaning that to run the business on day-to-day basis, sometimes they need a small amount of money to make a payment. Okay, like cash on delivery and so on. So most of the time, company would handle cash in hand or petty cash. So they would have like a what's this? A certain amount of money. Okay, it can be 1,000, it can be 5,000, depending on the needs of the company. It can be even 500. Okay, so it depends. There is no specific rules that mention what would be the best petty cash to be held, okay, by a particular account exec whatsoever. Okay, but as normally the amount will be stagnant. What do I mean by stagnant? Meaning that as a beginning, they will actually put inside, normally inside the box, 1,000 cash, okay, and then they will use it, all right, they will use it during the month, and normally at the end of the month, so whatever balance that they have, let's say they have a balance of 100, so they will top up another 900, okay, so that means at the beginning of the month, it will become 1,000 again. Okay, so that's why I said that the amount is normally stagnant, meaning that at the month closing, the amount of the petty cash on the financial position or financial statement will always be 1,000. Okay, but of course you have another book, right, just to maintain the petty cash expenses. Okay, so you have petty cash, right? You have cash at bank, you have cash in hand. And then apart from that, you also would have other instruments, okay, because sometimes company would have excess of money, all right. Some company might have in excess, all right, but some company have excess of money in the bank. So what they will do is that the excess of the money will be put in the bank. Okay, so in the bank, they have many instruments nowadays, all right? They have fixed deposit, but of course, fixed deposit, they have many kind of products. Okay, the one with the mudarabah, the one with the whatever the products that they have. Okay, so you would actually recognize this as part of the financial instrument. Okay, so when we audit cash and cash section. So these are all the items that normally we will cover simultaneously when we audit, because at the end of the day, why we cover all this? Because at the end of the day, we will get confirmation from the respective bank. So normally when they give the confirmation, they will list down all the products or whatever activities or services that you use with that particular bank. Okay, all right. So we go back here. When we're talking about cash and financial instrument section, so most of the time we have to know, okay, what are the major types of cash and financial instrument that the company have. So that's why we go into the trial balance. Normally we extract, okay, what are the items that fall under this category, because we don't want to miss out the items to be audited. Okay, so we identify from the trial balance all the types of the cash balances that I mentioned just now, or cash equivalents that we have already discussed under financial instrument. Okay, and then after that, we also will look at how the cash relationship to other transaction cycle. Okay, so if a big company, normally they would have one function where they call it treasury function. Okay, so that means whatever the cash in and cash out movement will go through the treasury function. Instead of, that means they have a separate function. They have the finance department or accounts department. At the same time, they also have treasury department. Okay, all right. So we will do all the audit tests. Okay, so normally we will do the testing of the general cash account and also financial instrument. So again, it's the same thing as before. Okay, when we do the test, our test is actually to test the chief whether it's actually fulfill, okay, the management assertions or audit objective that being stipulated in the financial position, meaning that we want to ensure that whatever item appear on the financial position is actually accurate, properly valued, okay, complete, has been recorded completely, okay, and it all belong to the company, all right, and so on. So it's actually follow the same audit objective as what what we learned in other cycle before. Okay, so the types of the cash and financial instrument, as I already mentioned just now, the general cash account where you have the normal bank account that get the collection from the account receivable, okay, and then you make the payment to the disbursement to the supplier and so on. Okay, and then you have impress payroll account. So impress payroll account is purely to monitor the payroll transaction. All right, and then you also have branch bank accounts. Okay, branch bank account is normally when you have many branches, okay, because sometimes you are the company that you have a presence of many branches. So in that case, every branch would have their own account. So in that case, you have many banks, okay, because each location would have each bank account. Okay, so alternatively, you can also centralize. So it depends on how you want to handle your bank account between you and also the branch, right? And then, as I mentioned just now, petty cash fund, okay, where it is actually a preset amount that being allocated for the company to utilize the money, okay, and also financial instrument, okay, so it's involved investment in marketable securities. So that's why it's called cash equivalent, because when you have marketable securities, it can easily be converted into cash. Okay, so whatever that can easily be converted into cash normally will be known as will be grouped as a financial instrument. Okay, so that's why in the cash flow statement you have the last line is cash and cash equivalents as at whatever date, okay, of the year end. Okay, so in a way, how it is actually related to other account, as we all know, okay, when you have sales, normally you debit either your receivables, but if you receive cash, you debit your cash, okay, and then you credit your revenue. Okay, so that is how it's actually affecting the sales revenue, is actually affecting cash cycle. When you're talking about disbursement to the supplier or purchasing to the from the supplier, of course, when you purchase, you debit your purchases and then you credit your bank for whatever disbursement that you make. Okay, so that is actually how it affect your cash cycle. And then when you have ordinary shares or equity, okay, issuance of shares, or maybe you make a payment of your dividend to the shareholders, again, somehow or other, it will touch your cash account as well. Okay, the same thing with other payment of the expenses, where you would actually have to go back to the debit your whatever expenses and so on, credit your cash account. Okay, so that's why if you notice in every cycle, somehow or other, it will still touch the cash and cash at bank account. Okay, so that's why when you audit cash, you have to be like really see how the cash is actually being used or utilized in the company. So the most important thing when we audit cash in bank, okay, or transaction cycle, most of the time you have to ensure the completeness and also accuracy. Okay, because somehow rather, if you notice, when you make your payment from the bank, okay, because your money is located in the bank, okay, so somehow rather, in the previous time, you would have timing differences. Okay, timing differences, right? Because last time we don't have digital kind of banking transaction, whereby when you make payment by paying, issuing the check. All right, so you post the check to the supplier presenting the check to the bank. Okay, so bank into the bank for the processing, and then once the bank process, then only the amount of check will be deducted from your account. Okay, so that is one of example. When talking about deposit, okay, what happened is that maybe you deposit towards the end of the year end. Okay, you deposit at the 4 p.m. on 31st December. So sometime because of that, you have deposits in transits. Okay, that means it's not yet captured inside the system. Okay, so the same thing. So that's what happened previously. What about now? Okay, because now most of the time when you do your transfer of money inside the online banking, okay, every time is being done by real time. Okay, everything is done by real time. So most of the time you don't have like items where you don't know whether it has been cleared or not and so on. But it's just that you might not know when you receive the collection, you might not know yet that that collection is actually from who until they notify you that we have actually made the payment, for what purpose, for which invoice, etc. and so on. Okay, so that's why when we do the audit of the cash at bank, most of the time we will do reconciliation. Okay, so reconciliation. So I hope that you still remember how to do your reconciliation. Reconciliation, I have already mentioned about reconciliation in supplier when we do the accounts payable, where you have supplier reconciliation. What does it mean actually by reconciliation? Okay, reconciliation means that you have the third party statement, okay, and then you have your own records. All right, so most of the time, especially the bank, your bank statement would not be exactly the same as per your cash book, okay, in your office, okay, in the system. All right, so you need to reconcile what has been taken up in the bank might not been taken up in your book, but there are also sometimes there are items that already been taken up in your book but not yet been taken up by the bank. Okay, so that is actually the purpose of bank reconciliation, or whatever reconciliation that you do. You want to reconcile the differences between one amount to the other amount. Okay, you want to see whether the differences is actually reconcilable, or you found any suspend item, which is your unknown item. All right, so with the unknown item, what do we do? Okay, because somehow or other, it will not balance out your book. Okay. So that is most very important when we audit bank cash at bank. The most important thing that we will ask would be bank reconciliation. So by doing the bank reconciliation, later I will share with you the bank reconciliation, and I will share with you how actually we do the audit of the bank for the bank reconciliation. So most of the time we want to ensure whatever appear in the GL is actually completely been taken up. Okay, completely been taken up in the ledger. Okay, because there are items that appear on the bank statement but have not been taken up. So in that case, you have to taken up. Most common is bank charges. Okay, most common is the bank charges, whereby bank charge, but then you do not know. You only wait for the statement at the end of the month to come. Then only you accrued inside your record inside your bank book. Okay, or bank ledger. All right. Okay. So that is the purpose of reconciliation. So normally by doing the reconciliation, okay, we would be able to identify the unpresented check as mentioned just now. Okay. Any item that appear on the bank statement but might not appear on your cash book, because sometimes people, especially nowadays, people just bank into your transfer into your bank account, but you did not know because they did not notify you when actually they bank in, how much is the amount, from who, and so on. All right. Okay. Of course, nowadays when you do the transfer, you can actually put the remarks, right? Okay, so to make it easier, sometimes they might use a standard remarks. Okay, normally the name of the company and also the invoice number. All right, so because of that, that is where sometimes you have item where timing differences. That means because nowadays you can do instant transfer, but sometimes you also have the old one is what, where it takes like 2 or 3 days, then only the money will be transferred to you. So for that matter, you would have timing differences item. Okay, the next one is the deposits. Okay, the deposits whereby you deposit, let's say sometimes you receive cash. Okay, you receive cash from your customer. So you already, of course, you already recorded in your book. Okay, but since you have not banked in the money into the bank, therefore your bank ledger has not been updated accordingly. Okay, so for that matter, these are also the item that you need to reconcile, because it's appear on your part but does not appear on the bank part. Like unpresented check, also the same thing. Okay, and then you also might have a third party transfer, okay, which is not being notified to you. So these are all the items that normally we will reconcile. You will find it in the reconciling items. And normally what do we do? Okay, when we do the audit, what do we do to verify? Because as an auditor, normally when you do reconciliation, the reconciling items are the one that we want to evaluate. Okay, the accuracy, the completeness, all right, the ownership, and so on. Okay, so it goes back to audit objective. Okay, but we will not detect. Okay, just now what we detect, this one is what we detect while doing the bank reconciliation. And this one is what we will not detect when we do reconciliation, meaning that we will not be able to check have we actually missed paying or bill to your customer. Okay, we also cannot check directly embezzlement of the cash. Okay, because sometimes when the sales is on cash, they paying, but then let's say your cashier did not record properly. Okay, so now the amount of the money is outside the cash book and it has not been recorded. It's easily can be taken by the embezzled by the person. Okay, by a person. So for that matter, all right, you will not be able, okay, to see that because it's still off of the bank ledger. All right, so once it touched the bank, because you did not record it, right? So that is actually how it cannot be detected when talking about embezzlement of the cash. And then duplicate payment of the vendor invoice, also you not know, you only know the payment has been made, but you will not know actually is actually for the same payment, two payments for the same invoice. Okay, duplicate payment. Right, so you overpaid lah to your customer, to your supplier. So how you want to retrieve that? And then sometimes improper payment of the officer's personnel expenditure. Okay, so meaning that because how should I say? I mean, you will notice the payment is going out. Okay, the money is being paid to the supplier or whatever, but you will not be able to see the payment is actually for nothing to do with the business activity. So personal expenditure. This is very common for enterprise company, where whatever personal expenditure incurred all charged to the business account. Alright, so here you will not be able to detect. And then payment for the raw material that were not received. Okay, sometimes you already paid, but then the item has not received. Okay, payment to employee for more hours than he or she worked. Okay, you pay extra. So that's why when you audit the payroll, you have to validate. You have to do the recalculation of the hours and then the OT, overtime. And then from there, you actually trace whether the amount is correct. Okay, once the amount is correct, has it been paid? So that's where you trace to the bank ledger. Okay, to trace. But how do you know that they actually overclaim the overtime? All right, you will not know. Okay, because so that's why there are certain things that you only know the money has received, the money has gone out. That's all that we know. Okay, for what purpose? Then you have to dig the supporting document. And then payment of interest to a third party for an amount in excess of the going rate. Okay, this is related party transaction, arm's length transaction. Okay, so arm's length transaction by right it should be either at market value or lower than market value. Okay, but here is mentioned about excess in the going rate. All right, so that's why most of the time when involve related parties transaction, okay, you would actually involve with the we want to know the nature of the nature of the relationship. Okay, how you related, how you associate, are you subsidiary, and so on. All right, and then you also want to know for what purpose the payment is being made and has it actually benchmark against the market value and so on. Okay, so all these things will not be detected from the doing the checking on the reconciliation. So audit of the cash, most of the time, similar to other cycle, first of all, we assess the risk. Okay, we assess the risk, how the cash could be a very significant risk for the company. All right. Okay, last time, I'm sure you are familiar with the plus. Okay, plus the one that collect toll. All right, so what happened is that last time, all the booth, you have one person waiting there and then you pay cash. Okay, you pay cash and then, of course, they have to record inside their system how many cash received and so on. Okay, so what happened is that when the worker or the employee work in the booth, collect cash, can it easily be embezzled or not? Can it just be easily take from the driver and then put inside your pocket without actually recording inside the system? Can it be easily done like that? Okay, we know that it's easily can be done like that. Okay, for instance, when you pass through the toll, all right, you pay them, they did not give you the ticket. Okay, and then they ask you to go. All right, so they can actually hold the ticket for the next driver. Come the next driver, they make the payment, all right, then they can pass your ticket to the next driver. So meaning that one driver is not being counted. Revenue from one driver is not being counted. So in that case, this is the risk that we have, okay, when talking about the nature of the business. Okay, so we need to understand the business. That's why in order to, this is the risk. Okay, the inherent risk got to the nature of the business where you actually dealing with the collection of toll, okay, in cash. So we know that that is the risk. So we have to hinder the risk, right? So what do? We take the control measure. So what would be the control measure? Of course, the control measure would be the moment you make the payment, you should have given the ticket. Okay, but it seems that it doesn't work. So alternatively, they put in the barrier gate, meaning that every time before you want to pass by, you have to really pay, or else the gate will not go up. Okay, that is one of the measure. But still, the money that being can easily be misappropriated by the employee. Okay, what they do, they just open the gate all the time. All right, so that's why we have to think: is the risk still feasible or will not be feasible? Okay, or can be deleted. So that's why you see nowadays the cash collection is no longer being used. Okay, we use the collection in the form of card. Okay, whether Touch and Go, Alfred, or Smart Tag whatsoever. But so they make use of that platform. Okay, so this is one of the mechanism where they can actually hinder the losing of the revenue from the toll collection. Okay, so once we know that if we the nature of the business is high risk, okay, because it's directly related to the cash element, therefore your performance materiality would be high. Okay, sorry, will be slightly low. All right, your performance, because it's high risk, right? So you tend to be put low because you want to check more. Okay, so performance materiality normally will be low, all right, because you want to ensure that you have actually assessed and you have actually tested, okay, how they manage the risk from the nature of the industry just now. Okay, what about control risk? Okay, control risk, of course, the control procedures within the cash cycle. Okay, meaning that when you make your payment, how do you know you made the payment to the authorized person? Okay, are you being paid the payment to the right supplier? Are you made the payment the right amount? Are you made the payment for the right transaction? Or is it the transaction that have been paid, which is duplicate payment or what? Okay, so that's in terms of the payment. And then of course, in terms of the collection. Okay, collection also you have to monitor how the collection is actually being done. Because especially when you do your collection through cash, okay, so that's why nowadays we can see that a lot of all these QR code payment is actually exponentially explode because of the risk that the money can be easily be misappropriated. Hence, what they do, they actually come up with that particular tool in order to overcome the risk of losing the cash. Okay, so independent bank reconciliation. Okay, nowadays I think the life is getting much simpler, right? The bank reconciliation, even if the company have the right software, it can easily be done by the software. Okay, they can actually do the mapping and matching, okay, from the cash ledger to the bank statement, and then from there they trace, and then they can do the reconciliation and come up with the reconciliation. Or else you have to do it manually. Okay, you have to do it manually. But who prepared the bank reconciliation is not the auditor who prepared the bank reconciliation. It should be done. Okay, it should be done by the respective employee in the company. Okay, respective employee in the company must prepare the bank reconciliation, and then someone authorize it. Okay, someone authorize it. That means normally the lower level prepare, and then the other person would actually do the authorization, meaning that they will check whether the work is being done properly or not, and so on. Okay, so that is on the client side. Okay, so once we have done the assessment of the nature of the business, assessment of the risk, assessment of the controls, hence we perform tests of control and also substantive testing. So the phase 2 is where you are already in the field work, okay, where you perform your audit test. Okay, so audit test, you know that we have test of control, we have substantive testing, ethical procedures, and also test of balances. Okay, so this is what we are going to do in the field work. All right, so this is an example of, here is the audit objective. Okay, so here is the procedures that you will do. Okay, what do we do? If let's say here we want to check the reconciliation between the bank and also the ledger is actually the amount is tally. So what do? We foot. Okay, foot ni we casting we count lah. Okay, forecasting is actually the same thing. The common word that we always use in the audit procedure. Okay, we do the footing of the outstanding check and electronic payment and so on. And then we cross check, okay, the addition and subtraction is actually correct, okay, because sometimes there are also tendency to make mistake as well. All right, and then trace the book balance from the reconciliation to the ledger. All right, so later I will show to you what actually we do when we audit the bank reconciliation. Okay, so you have this list for you to refer to later. Okay. Right. So when talking about year-end balance, okay, year-end balance means balance as at 31st December. Because my bank normally would give you the bank statement on monthly basis, especially current account. Because saving account, I noticed that most of the time they will just give a quarterly basis if it is dormant. Okay, but like saving a current account for business, normally they are so rely too much on the current account because there are also other facilities that can come together with the current account. So in the current account, okay, so most of the time we will get confirmation, okay, confirmation from the bank. And in fact, nowadays also it's also much easier nowadays whereby a certain bank immediately issue bank confirmation to the respective auditor online. Okay, all right, they make use of the digital banking, all right, and then what they will do, let's say auditor of company A would like to request bank confirmation, so they notify the bank and the bank will put that on the system. All right, so from the other side, from the client side, it will retrieve and print and give it to the auditor. Okay, because last time it takes long time. Okay, because last time what we do, we fill up the confirmation slip. Okay, we post to the bank and then the bank would actually reply by giving us the statement of account. Okay, statement of account for the respective accounting period. Okay, so from there you actually will do the reconciliation. Okay, so in the bank confirmation, apart from stating how much is the balance of the how much is the balance of the money inside the bank, okay, bank A, bank B, in that particular bank, account 1, account 2, and so on. Okay, so they will list down because most of the time company did not rely only on one bank. Okay, they try to rely more on the multiple banks as well. Okay, as I mentioned just now, for different purpose just now, right? Okay, so once we get confirmation, then this is what we are going to do the bank reconciliation later on. Okay, that's one. Secondly, you want to check the cut-off bank activity after year end. Okay, so that means you want to ensure that whatever transactions that belong to the year, let's say 2021, should be captured in the account of 2021. All right, whatever should be captured in the 2022, then should be captured in the 2022 expenses. So that's why, like today is 2nd January, right? So this is because companies start already busy with the closing of the account. 31st December always the year end, right? Okay, so lots of companies are actually busy tidying up their account whereby they want to ensure that now whatever payment, is it related to 2021 or is it related to 2022? So you want to ensure that a proper cutoff is actually being done. Okay, proper cutoff is actually being done. Okay, as at year end. All right, because you want to reconcile. Okay, later on, what are the money that received, what are the money that going out. Okay, the next one is the bank reconciliation. Okay, bank reconciliation, let me show it to you. Okay, these are the bank reconciliation. Can you all see my PDF on the screen?
Yes, madam.
Okay, this is bank reconciliation. So most of the time, one of the good control as well, bank reconciliation must be done on monthly basis. Okay, bank reconciliation must be done on monthly basis. That's number one. Number two is prepared by the lower executive, and then it must have been approved by another supervisor. Okay, so these are the control. So the first is must be done on monthly basis so that we know ongoing basis what are the items that keep coming in from January up until December. So that's why we have to do it on monthly basis. And then someone prepare, someone review and check. Okay, so let's check here. Do they have that or not? So you can see that they don't have prepared by who, approved by who, right? Okay, on the bank reconciliation print. So this is one of the control measures that you want to highlight to the client. Look, your bank recon is prepared, but no one claimed who did it, and then no one also checked. Okay, the figures or whatever the calculation on the bank reconciliation. Okay, all right, so that's the first two, the controls. All right, the next thing is that what do? Is we double check here. You would normally have balance as per bank statement, and then you would have balance as per bank account. Okay, so balance as per bank statement, where does it come from? It is actually coming from the bank. Okay, it's coming from the bank statement as at 31st December. Okay, so what do? You take this figure, you check this figure, and you cross-check to the bank statement. Is it the same figure or not? Okay, is it the same figure or not? Right, so if it is the same figure, then you put your audit text. Okay, so let's say for instance, bank statement. Okay, so later here at the bottom, what do? Okay, audit text. So one is cited or agreed to bank statement. Okay. Right. Okay, the next one. Okay, we agreed the balance, whatever asset as per bank statement is already checked and is actually tallied to the bank statement. That's the first one. Second one, we check here, balance as per bank account. All right, balance as per bank account. So here, where does the figures come from? The figures actually coming from ledger, right? Okay, or trial balance. All right, this is the closing balance as per our ledger. Okay, so what do? Of course, our audit work is we agreed to the GL. Okay, we agreed to the GL or we agreed to the TB. Depends lah, whichever document that you use as a reference. So here we add on that. Okay, now we have done the second audit procedure, which is cited to GL. So we have agreed to general ledger. Or you want to also to say to trial balance. So we know already, okay, completeness. That means the figures is actually taken from the respective record. Okay, because now you are comparing, as I mentioned just now, reconciliation is to compare balance in your book and balance to the balance that situated in the bank statement. It will always have a difference. Okay, so that is where you need to reconcile. Okay, you are done, All right, so we agreed the balance as per bank statement, balance as per bank account. So what we do next? Okay, before we audit all these things, we do the calculation. We recalculate. Has it been correctly calculated or not? Because sometimes maybe the formula is wrong. Okay, so therefore, the figures might be wrong here. So what do? We cost check lah. Okay, we do the casting. Okay, so here balance per bank statement. So this is the deposit not credited to the bank. So meaning in the ledger has been recorded but in the bank has not been recorded. So that's why you add to the bank statement balance. So this plus this should get this. Okay, so you do the casting. Alright, so the tick normally will be like this. Okay, and then you do another casting for the unpresented check. Okay, unpresented check whereby you have issued a check but the check has not been cleared by the bank. Okay, the check has not been cleared by the bank. That's why you should have minus the amount of check from the bank statement, because if it's cleared, that means the bank will reduce the money. Okay, so that's why you minus all the unpresented check. So what do? We cross-check all the figures. Okay, so we know that this 28,000 is actually the total of all these figures. You can double check. I did not check. Okay, so we do the casting of this figure. And then from there, we take this figure minus this, right? So should get this. So again, we show that. All right, so here, so here, casting, check. Okay, so that we know. All right, so meaning that we already know. Okay, so already know that by looking at this, we know that now the calculation has been checked. Okay, so that's what we do. Okay, the next thing is that, okay, we already cross-check this figure, we already cross-check the figure, we already cross-casting all the calculation. So now we want to verify the items on the reconciling items. So what do? Here, the item is deposit not credited by the bank. Okay, so that means that the money has been received but not yet being debited to the bank, not yet being credited to the bank, right? So what do? As per, this is as per when? As per December. As per January, okay, let's say for instance, as per January, in the bank statement of January is not yet being credited, meaning when it will be credited? It will be credited in the month of February. Okay, in the month of February. So you can actually, what we do, normally we trace to the bank statement in the February. Okay, we check whether this amount has been deposited or not. If it is yes, then we can actually put here bank statement, meaning that it has been agreed or cited to the bank statement, or sometimes you might also want to put in the date when it is actually being what is this? Credited by the bank. That means the timing difference. Okay, why I mentioned about the date? Okay, so let's say we put the date is cleared or deposit. Cleared on the bank. Okay, on the 4th February 026. Okay, why 026? Right. So we put the remarks there so that we know. Okay, by looking at this, BS is what? BS is accurate to bank statement, right? So meaning that we know that this one has appeared on the bank statement. When does it appear? On the 4th of February. Okay, why we want to put the date? Okay, why we want to put the date? All right, we want to put the date because this is also another control, meaning when the company receive the cash, how long they handle the cash. Okay, how long they handle the cash. Because why? Because cash is highly risk. Okay, very high risk, because people can just take the cash. If you do not put in the deposit, people can simply take the cash and take it out from the, misappropriate the cash. Okay, so that's why we want to know how long you, how many days that you hold your cash in your office. Okay, so but the best should be within 2 to 3 days, less than 5 days. Okay, less than 5 days. So if let's say year end is 31st December, 31st January, and then you bank in, everything is cleared on the 4th of February, that means we know it's very time, a short time frame. They receive the money and they bank in. Okay, but if we notice that in the, let's say we notice when we cross check the bank statement, this is the bank reconciliation as at January, right? So when we check bank statement in February, also not cleared. Then when we check statement in the March, then only it is cleared. Then we know they hold the cash for so long. Okay, they hold the cash for so long. So this is what we can do. We go back and ask the client, how long do you take to bank in the money? Okay, so if it is contradicting, then we know actually that person make use of the money first, then only they put back in the bank account. Okay, so that's why as an auditor, you have to like very suspicious, be careful. Okay, when you have what we call this, some trigger point. Okay, for you to inquire further from your client. Okay, so you put in the date when it is being credited. Okay, now we are done because only one deposit, the item that we have. Okay, now we have the next one is the unpresented check. Okay, so you might not do all, okay, because in this case it's only 5, but in certain company you might have like 2-3 pages of unpresented check. So you can imagine how big transactions of the company. Hence, we normally did not do the whole thing. We will pick up sampling, but of course, normally on the material amount. So in this case, maybe we just cited Maha Silk, okay, Penny Fiber, and also batik and fabric manufacturer. Okay, so what do? We take this, and also take this. All right, so this is unpresented check, right? So meaning the check has not been cleared in the bank statement. So what we do is that we go again, we trace to the bank statement when it is actually be presented. So if this is all has been issued in the month of month of January, so we will see how or when it is actually be presented. So let's say this one we trace to the bank statement in February. It is presented in the month of February on the 7th of February. Okay, Y026. Okay, so maybe it's already presented. Then it's okay. All right, so that's settled. And then the second one, penny fiber. Okay, 9988. You trace to the bank statement. All right, you trace to the bank statement, but still it is unclear. Okay, until now the point of the audit still unclear. All right, still unclear. So you want to, that means now you know that there is one item that has not been cleared. So by right should not have already been credited into the bank account. Okay, and then here you have batik fiber. So again, you trace to the bank statement. Okay, you trace to the bank statement. And then you found out that they only cleared on the month of March. So you just put in the date, the month of March, 6th of March, Y026. Okay, so that is actually how we do the audit of bank reconciliation. So basically, now we have verified almost all the item on the bank reconciliation. Okay, we agreed the balance and then we cross-cast. Okay, and then after that we verified the check. Okay, when it is actually being cleared by the client. By the bank. All right, so that is actually how we do the audit on the bank reconciliation. So it's not that difficult. So most of the time, these are the sections that commonly being done by the junior. Okay, the first item when you first join the audit team, the first area that you will be assigned will be, okay, you audit cash and cash equivalent, the other party audit and event apa ni fixed asset or whatever. So this is all the most common, because normally they want to teach you how to do audit, right? So they will expose you to the most easiest section that can be audited. Okay, so this is what we do. So if you have many banks, then we will settle all the banks lah. Okay, we will settle all the banks doing the same thing as like this. Okay, so once we have done this, let's say there is no errors, perhaps this is not an issue yet because it's just being issued recently. Okay, but if it has been issued, let's say for more than 6 months, then perhaps you have errors. Okay, so maybe if let's say you have errors, you want to put the note. Okay, just example, just give you as an example. So let's say note number 1, you want to say that the check has expired. Okay, why I said the check has expired? Because we know that the check after 6 months, your check will be expired. That means if you present to the bank also, no point because it cannot be cleared. Okay, that's why if you have the check, you have expiry date. Okay, that is with regard to the issues if you have. So you just highlighted in your working paper. So other than that, if there is no other issue, everything is like clear. Okay, basically you can conclude that. So for overall, for these sections, okay, so conclusion, okay, everything is fairly stated. Sometimes the common term is no exception noted. These are all the common term lah. Okay, I mean by looking at the conclusion, we know that for this account, for this balance, okay, clear, no issues. That's how we actually do it. Okay, so this is an example of one audit working paper. So you can just straight away do on the bank reconciliation rather than copy back and put it inside your working paper. So this statement is actually given by the client to you. Okay, any question or not on the bank reconciliation? Can you all follow how to do it? Any question? Okay, so looks easy, right? Okay. All right, so if no question, then we move on to other question? No? No question? All right, if no question, then we move on. So that is actually explain how the test of bank reconciliation is actually being done. So you verify the mathematical accuracy of the bank reconciliation, the casting just now. Okay, you trace the balance on the confirmation or bank statement. All right, you trace the check to the following bank statement, okay, and then you trace your deposit to the following bank statement, right? And also take note of all other item that should be appeared on the bank reconciliation. Okay, for instance, like just now, you trace whatever on the ledger to the bank statement. And then the next thing is you also want to trace whatever item on the bank statement but to the client book. Okay, because sometimes you might have also have items on the bank statement which not yet been captured in your cash book, like bank charges, interest, or whatever. Okay, whatever item that sometimes you bank charge you, but you have not been advised. Okay, you might not receive the advice, therefore you have not captured in your book. So these are all the common item, okay, that you have in your bank reconciliation. Okay, so basically, all right, how the fraud could happen. Actually, if you read about Satyam case, Satyam, Satyam case in India. is a company in India. Is involved fraudulent in their financial reporting. So their fraud is actually initiated by manipulation of the accounts of the bank statement. Okay, bank account through the bank reconciliation. They do the manipulation, so they later on the fraud being found, okay, by the auditor. So it's one of the big case that happened around the world. Okay, so don't think that looks easy by doing the audit of the bank record, but actually it also involve the elements of possible fraud to happen. Okay, so here fraud oriented procedure refer to what are the area that could possibly for fraud to happen. Okay, what are the area could possibly create the possibility of the fraud to happen. Okay, so definitely it will happen when the internal control is not adequate. Okay, that's why if you notice from time to time, I highlight what are the controls that you need to have. So if you don't have that control, definitely it will be have a tendency, okay, for people to misuse to misuse their power to do the access to the accounting records and so on. All right. So okay, so what do we do is that, all right, we actually sometimes, let's say year end is 31st December, right? So 31st December, so most of the time we actually do the bank recon for December. Okay, but sometimes if we know that the company has a high risk in the cash cycle, so normally we extended the bank recon that we do the testing. Okay, instead of just looking at the month of December, we also ask client, I want to see your November bank reconciliation. Okay, I want also to see perhaps sometimes January bank reconciliation. All right, because why? Because one of the reasons just I mentioned, control, bank reconciliation must be prepared on monthly basis. Okay, sometimes they know that auditor definitely will ask for the bank reconciliation on the 31st December. They just do bank reconciliation for 31st December. You ask for November, they don't have. You ask for October, they don't have, and so on. So when you ask this, they don't have, then they actually violate their control procedures. Okay, so that's why we sometimes go beyond the bank reconciliation for month end, for year end. Okay, we extended. What we do, still the same thing like just now. Okay, we agreed the balance as per bank statement, as per cash book, and then we trace all the reconciling items. Okay, the unpresented check and also deposits in transit. We all reconciling between the month and also the bank. Okay. All right, and then another area, okay, that also would be possible to have fraudulent is petty cash. Okay, petty cash. All right, petty cash, because sometimes what happen is that people may use for their own personal use and they pay later. Okay, so that's why sometimes we do the what we call this physical count. Okay, physical count. Remember in the last class I mentioned about stock count. Okay, where you go to the client, you count the stock on sampling basis. Okay, so here is you do the same, you do the counting, but it's not on inventory, but it is on the petty cash. Okay, so what happened is that during the we can do this during the audit, or we can also do this during the stock count time. Right, because some company they do during that time, because during that time the business is closed, so like business is stopped temporarily for that time, so they can actually what is this audit. Okay, they can actually audit how the petty cash is actually being handled. So what do? They take the whole cash and then they count specifically, and then from the records, is it tally or not? Okay, is it tally or not? So that is also where you want to detect, is there any possible fraudulent to happen or not. Okay, because you wouldn't know, alright, because talking about petty cash, it can also be easily be misappropriated or misused. Okay, and then test of interbank transfer. This is also another problem. What happened is that because this is the issue also for the what is this? Money laundering. Okay, money laundering. Okay, what is money laundering? For your own knowledge, money laundering is when you transfer your money for non-business purposes. Okay, for non-business purposes, and sometimes it can be illegal with illegal purpose. Okay, for the illegal purpose. So that's why nowadays, whenever you want to transfer your money, the bank will actually ask you. Okay, either you transfer in or you transfer out. Transfer in meaning you bank in lah. Transfer out means you transfer, you withdraw. So nowadays is very stringent. For instance, you want to bank in 10,000 inside your bank account. Okay, so 10,000 normally we do over the counter. So when we do over the counter, we bank in, then there will be a lot of question that the bank officer will ask you. Okay, who do you bank into? Okay, what is the purpose? Do you know that person? All right, and then where do you get the money? Where the money come from? Okay, so they will ask all sorts of reasons. Okay, they will ask all sorts of information because they need to fill up the relevant form that actually been prepared by the bank negara just to ensure or to detect whether is there any possibility of money laundering to happen or not. Okay, for money laundering to happen or not. All right, so there is another control that being enforced not only by the company but by bank negara, okay, by the central bank, just to ensure there is no improper transfer of money. Okay, even though I'm sure if you read about the certain case, you should be wonder why, despite of having all those procedures on the money laundering, but yet there are things that happen, where unauthorized transfer that happen. Okay, another thing when talking about transfer, okay, what happened is that nowadays, okay, with the analytics, auditor, what they do, another testing that they do, which is not been done before, because before we don't have the tools to use it, we don't have the software to use it, okay, to do the testing. All right, so but nowadays with the Excel, advanced Excel, what they do, they download the whole database from the cash balances. Okay, they download from the system, they download the whole transaction. Maybe they pick up certain months, they pick up, let's say, by the month, because 1 month is already thousands of transaction for certain company. So what they will do, they download the whole transactions for the month, and then once they download the whole transaction for the month, they would actually trace, okay, from the transaction, what are the common transactions that happen during the month, what are the irregularities or non-common transactions that happen during the month. Okay, right, because we know during the business you make payment, you get collection, you pay salary, you pay for expenses, etc., so on. Okay, and then suddenly you have this one weird transactions. Okay, so this is also what auditors do nowadays. Okay, for your information, this is what because I what's this? Because this is what being highlighted by the audit firm when we go for practical training visit. Actually, they highlight that the students should be able to know how to use Excel. Okay, because if they know advanced or macro, even better, because these are the testing that sometimes they do, and they also ask the junior staff or the normally the junior staff of the audit to do this. Okay, because when you do the analysis from there, you can see the pattern. All right, that is where sometimes you can see the weird pattern transactions that occurred in that particular bank transaction. Okay, so this is also another angle that being used in the audit through the use of analytics. Okay, it's just a simple Excel actually. All right, so from there they visualize and they can see the pattern. Okay, basically you study the pattern actually. Okay, you study the pattern of the transactions. Okay, so you are looking for non-common transactions that happen in the bank. Okay. All right, so this is another example of the working paper. Okay, this is another example of working paper. But of course, in every working paper, you must have this, you must have the name of the company, the year end, okay, the reference, all right, prepared by who, approved by who. So prepared ni whoever that prepared the working paper lah. All right, who prepare, when do you prepare, and then review, approved ni review. Review by who? Normally we just put our initial. Okay, we just put our initial. So when you enter into the audit firm, you have your own initial from your name. So by looking at the initial, we know already these are the one that doing it. Okay, and then the date when you actually review. All right, so you see here, so you see all the tick. Okay, that is how we put the audit tick, and then how we explain, okay, the audit tick. All right, basically by explaining the audit tick, this is the audit procedure, and then if you notice from this, you also will able to know what audit evidence that you have actually cited. Okay, so is that audit evidence reliable, relevant, adequate, and so on and so forth. Okay, so this is actually how the audit working paper have. Then if you have any notes, then of course you put the notes at the end lah. Okay, all right. So this is actually first part. Okay, how you do the audit of the cash at bank and also cash in hand. All right. Okay. For the last one, for the petty cash or cash in hand, like cash at bank, you get confirmation from the bank. Okay, you get confirmation from the bank, but for the petty cash, normally you get confirmation from the CEO, from the CFO lah. Okay, from the CFO, just to confirm the balance of the petty cash as at year end is how much. That's all. Okay, so that is the confirmation. All right. So I think that's all I want to focus on first today, which is how to audit cash in hand and also cash at bank.